Hi guys, welcome back to the channel. It's Arab the Plug, and this is yet another technical analysis video where I will be teaching you some very important technical analysis concepts that would help you increase your capability in analyzing the crypto, the forex, or even the stock market, and which is going to eventually help you make more money from the market. So if you're interested in content like this, content like technical analysis, how to trade the forex market, how to trade the crypto market, ensure you subscribe to the channel. And also I would appreciate if you can assist with by clicking the like on this video so that this video gets to a lot of people and they get to benefit from it. So I would appreciate if you can do that right now, just before we get into the content proper. Have you done that? Yes, let's go. So this video is going to be a complete tutorial on candlestick patterns. As you all know, candlestick patterns is a very important course in the technical analysis of any financial market in the world, and candlestick pattern is actually something you can't do without, because no matter the concept you trade, whether you trade the smart money concept or you trade the regular technical analysis, demand and supply, you trade order blocks, you trade breaker blocks, anything you trade, you actually need candlestick patterns as confirmation for anything you want to, any concept you want to trade in the forex or the crypto market. So going by that, it's simple to say that candlestick patterns is one of the most important topics in the financial market, and without it you hardly can make any reasonable thing from trading. So let's get right into the content and let's sit back and enjoy. So this is actually going to be a pretty long one, but I'm very sure it's going to be worth it. So stick to the end so that you can get the maximum benefit from whatever we'll be talking about today. So now, talking about candlestick patterns, before we talk about candlestick pattern, it's actually important that we talk about the anatomy of candlestick, because candlestick patterns is more like patterns that are formed on the chart by candlesticks. And you know, on your chart, what we have on your chart is candlestick. Candlesticks are the candles that are formed on your chart that we have on your chart. You can see that looking at this chart, we have different candles. This is a candle, this is another candle, this is another candle. So these candles, these charts are formed by the formation of different candles. Now, when you see stuff like this, you see that these candles, when they form, even though it is one candle after another, but when they form patterns, and those patterns have meaning. They have meanings they convey to you as a trader. And from this pattern, or from the meaning of this pattern, you'll be able to make decisions on what you are likely going to do next in your trading journey. So these patterns are things that they are formation, or they are pattern formation that are formed on your chart that help you decide, that help you tell whether the market is going to go bullish or probably going to go bearish. But before we talk about candlestick patterns, let's first talk about the anatomy of candlestick for those of us that do not know what candlestick really means and how we go about deriving what candlestick is. So now let's talk about what candlestick is. This is a candlestick, and this is the anatomy of a candlestick. So now let's go. You see that in this picture we have right here, we have two candles. One is green and the other is red. So the green candle is used to signify a bullish candle, while the red candle is used to signify a bearish candle. A bullish candle simply means a candle where the market goes up because candles represent the movement of the market. Yeah, let's put it that way. Candles represent the movement of the market. And if you look at the market, you will see that here, this green candle represents the movement of Euro CAD from 1.47745 to 1.48505. This is the movement from this place up to this place, and that's a bullish candle because the candle signifies movement from like a lower price to a higher price. And the bearish candle, something like this one, signifies the movement of the candle from 1.48990 down to 1.48642. That's a bearish candle. That's why it is in a red color. Sometimes when people change it to like black and white, you can change it actually to anything you like, but basically green candle is used to signify a bullish candle, which means like the price went up, and the red is used to signify a bearish candle where price went down. That's the first thing. Also, the second thing is that the candles have body and wick or shadow. So the body is like the real body of the candle, just like we have in this kind of candle now. Look at let's look at this candle right here. Like the candle has a body, right, and it has like a shadow up here that is like in form of a thin line, and also down here it has something like a thin line. So the thin part of the candle, which is like up and down, is what we call the shadow. So the one up is the upper shadow, the one down is the lower shadow. Same for the bearish candle too. So, and the real body is like the real exact body of the candle. So now, candles usually have four major components. We have the open price, which means, before I talk about that, candlestick always have time frames. Like, like your charts too, you have time frame, which is more like, okay, the time frame in which each candle in the charts represents. So for this candle, we have the 4-hour time frame, which means each candle you see on the chart represents the movement of the price within 4 hours. After every 4 hours, candles close and we have a new candle. So now, for example, let's say this candle represents the movement of the price in 4 hours. It means this open price is where price opened within the 4 hours. So when the 4-hour movement started, it opened at the price. Then this low is the lowest point the price reached during the 4-hour movement. It means during the 4-hour movement, price came down and created a low at this place. Then the price went up again, and the highest price it was able to reach within this 4 hours is the high, and it closed here. So which means that the candle opened down here, went down a little bit, but it could not stay down. The bulls kept pushing it up, went as high as this, but later came down and closed here, and eventually is a bullish candle because it's closed higher than where it opened, right? So the concept is that when the candle opened a little bit down and it went up to close at a higher price, we call it a bullish candle because it's more like the price moved from a higher part, a higher angle, a lower angle to a higher angle. And the opposite is for the bearish candle. For the bearish candle, price opened up, which means the movement started at a higher price. It tried to push up to create a high for the movement, which is like this is the high of the movement. Then price started dropping, dropped as low as this, and it closed here. So this is telling us that price started at a higher point, tried to push higher, but it could not, and started dropping to the lowest point, and it eventually moved a little bit up and closed at this point, which is like the close. So every candle has an open price, the highest point that the price reached during the movement, whether it's 4-hour candle or 2 minutes candle or 5 minutes candle, no matter the time frame, candlestick patterns or candlestick charts are almost the same, and this is the lowest point, right? So let's get right into our chart and let me show you a real candle and how you can actually identify them. So now, looking at this Euro Canadian dollar chart, you will see that this candle that I'm currently highlighting, let me just highlight this candle. This red candle that I currently highlight is a bearish candle, right? And this is the open price. This place is the open price because the candle opened here, right? That's the open price. This is where the candle opened, 1.47508. Then during this movement for the 4-hour, because it's a 4-hour chart, price went up to 1.47579. That is the high of the candle. This is the high of the candle, right? And then price came down. From that point, it started coming down and it's created a low of the candle here. This is the low of the candle because that's the lowest point price reached during that movement, that 4-hour movement. Then it closed here. So you see that the place where the candle closed is the same place where the next candle following it is going to open, because it is like the signifying movement of every 4-hour in the market. So that's it. So this is the opening price. This is the highest point the price reached during this movement. That's the high of the candle, and this is the lowest point price reached during the movement. This is the low of the candle, and this is the closing price. So so let's get rid of that quickly so that we can do the next candle. So for the next candle, that is the bullish candle that followed it, which signifies the movement of price upward, right? Then you see that the candle opened right here. That's the opening price of the candle, right? That's the opening price of the candle. Then when the candle opened, it's moved down a little bit before it started moving up. So the lowest point it got, that's the low of the candle, then the price started moving up during this candle movement, and the highest point it reached is here, which is the high of the candle, and this is where the candle actually closed eventually. You see that where the candle closed is exactly where the following candle opened. So that is pretty much the anatomy of candlestick. It is simple, easy, and straightforward. So that is what candlestick stands for. That is how to understand candlestick. Now let's go proper into candlestick patterns. So what is candlestick patterns? Candlestick patterns are patterns formed by candlestick on the chart. So when you talk about candlestick pattern, it's more like candlestick having a shape that is maybe different from the regular candlestick shape. It might be different, and it might be like the normal candle. If you look at the candle in the market, you see that we have different kind of candle. You see that this candle has a very long shadow to the upside. You see that some candles do not have long shadows. Some candles do not have shadows at all. Some candles have a very long shadow and a very thin body. So these candles form different patterns, which tells us different meaning in the chart. And this is how a trader identifies movement of candle and what is likely going to happen next in the chart. So we have different kind of candlestick patterns in the market, and if you look at the forex market or the crypto market or any market using technical analysis, you see that we have different kind of candlestick patterns. We have a lot of them, and you cannot actually memorize all of them. It doesn't matter. It's not necessary to memorize all the candlestick patterns. But what matters is that once you see a candlestick pattern, you should be able to determine, or you should be able to explain what the pattern means. Right? Once you see them, you should be able to tell this candlestick pattern is telling us the price is about to move upward, or this candlestick is telling us the price is about to move downward. That is the most important part of candlestick pattern. You should be able to tell what each candlestick pattern signifies. And when we talk about this, you also have to know that candlestick pattern might be a formation of one candlestick, or two candlesticks, or three candlesticks. But for the sake of this video, I'll be talking about 5 candlestick patterns that matters the most, the ones that I use the most, and the ones that I feel that if I teach you in this video, you'll be able to make the best of them in your trading. So let's get right into these candlestick patterns. The first candlestick pattern we'll be talking about is the engulfing pattern. What is an engulfing pattern? As the name implies, engulfing pattern is a candlestick pattern where one candle completely engulfs the other. It means it swallows the other candle. That is simply the meaning of engulfing pattern. So if you look at the candlestick, you see that engulfing pattern is like 2 different patterns. There is bullish engulfing and there is bearish engulfing. Bullish engulfing pattern simply is telling us the market is about to reverse and start going bullish. And the bearish engulfing is telling us the market is going to reverse and start going bearish. And if you look at the bullish engulfing pattern, you see that it is 2 candles formed together. That is why I tell you that on top of candlestick pattern, it might be 1 candle, it might be 2, it might be 3, it might be 4, and even more. So bullish engulfing pattern is more like, okay, we have a bearish candle. Then after the bearish candle, we now have a bullish candle that completely engulfs the previous bearish candle. So now, this is bearish candle, which is signifying that the market is going down. Then after it, a bullish candle now comes and completely engulfs it. It completely covers it. And the rule with the bullish engulfing candle is that in engulfing candle, the following candle, the second candle, must completely engulf the previous one. And you can see this is a candle that completely covers or completely swallows the previous one, telling us even though the market has been bearish, then it is about to start going bullish. For example, let's say in the market is coming to a support. Let's say, this is a support level in the market, and the market is coming this way. Let's say the market is coming this way, right? And it's come to a support, right? And you know, at support levels, you want to be looking for opportunities to buy. I made a video about support and resistance. It is linked in the description below, so do watch that. So, you know, at support level, you are looking for opportunities to buy, but the market is coming down. You are seeing red candles, and when it gets here, it now forms a bullish engulfing candle. The market gives you a red candle, then after it, a green candle that completely engulfs it, telling you that the market is about to start reversing, and with that, the market is likely to start going upward. That is simply what a bullish engulfing does in the chart. So bullish engulfing pattern is more like a pattern, a reversal pattern, telling you the market that has been going bearish is likely about to reverse. Even though when I teach candlestick pattern, I tell people that candlestick pattern doesn't really mean that the market is going to start reversing immediately. It is just a signal for you. Then you as a trader have to find ways to enter the market, to find the best entry, because you don't enter immediately at the candlestick patterns, and also you don't trade candlestick patterns in isolation. You have to combine them with some different other concepts in the market to be able to get the best and the most accurate trading decision. So now, that's the bullish engulfing pattern. Bearish engulfing pattern is pretty much an opposite of the bullish engulfing pattern, which means the market is maybe in a bullish movement, and it gets to a stage whereby it hits a resistance level or area of supply, and at that point, it means that the bulls are getting tired and they are unable to continue. They are unable to continue with the movement. So, which means that the bears have completely engulfed the bulls, and the market is about to reverse and start going down. So, bullish engulfing pattern is a bullish candlestick, which is telling us the market is likely going to start going up, and the bearish engulfing pattern is more like the bearish candlestick, telling us the market is likely going to come down. But for candlestick, you don't trade candlestick in isolation. I always advise that when you trade candlestick, you trade them in combination with support and resistance and some other important market concepts that you trade. So let's look at this candle. Let's look at this market, for example. You would see that in this situation, the market is actually bullish, but when the market came up here, it reversed and created a support area here. You see that this support has been tested the previous, tested here again, and it's going to be tested again in the next couple of hours, and the market is likely going to come down here and test this support. So now, looking at this movement, when the market came down here, it is a bearish movement, right? You as a trader at this area of support, you want to be looking for opportunities to buy, right? And at this point, you want to be looking for opportunities to take a bullish trade. And how do you know the market is likely going to start going up? You look for candlestick pattern that signify that. And here we have the bullish engulfing candlestick pattern. Simple and straightforward. We have two candlesticks here, right? Two candlesticks that form this bullish engulfing pattern. And if you look at these two candlesticks, you see that the first one is bearish, this one, and the following one is bullish. And it completely engulfs the previous candle. So that is why we call it the bullish engulfing candle. And what happened after the bullish engulfing pattern? The markets calculated in price, and it gives us a movement from this point to this point, which is like a movement that if you trade it, you are likely going to get a reasonable reward from that. So that is what a bullish engulfing pattern simply means. I'm pretty much going to look at different charts to spot the bullish and bearish engulfing pattern, but both the bullish and the bearish engulfing pattern are most likely the same thing. And when I spot these patterns, I usually spot them at areas of support and resistance, not just anywhere in the chart, because bullish and bearish engulfing pattern all these patterns are useless if you trade them in isolation. Patterns can form anywhere on the chart, but if you trade them in isolation or you trade them without combining other important technical concepts, you are most likely going to lose the trade. You are most likely not going to make profit from the trade. So now, that is the first pattern. So let's go to the second pattern I'll be talking about in this video. The second candlestick pattern I'll be talking about in this video is the tweezers. Tweezer patterns, or what we call tweezer top and tweezer bottom, is a kind of candlestick pattern that involves two candles as well. And one is all bearish and the other is bullish, like we had in the bullish and bearish engulfing pattern. But if you look at this pattern, you see that it's different from the bullish and bearish engulfing, because in this pattern, one does not actually engulf the other. It's more like, most of the time, it's more like the same. The candles always have the same size. Not always, but most times it has the same size. And sometimes it may not have the same size, but one will not be too big that it will be able to engulf the other. So this one is called tweezer. And we have tweezer top and we have tweezer bottom. Most of the time when we have tweezer top, it is always at the resistance. Most of the time that we trade tweezer top is at the resistance. And most of the time when we trade tweezer bottom, it is at the support level. Right? Or let's say most of the time when we have tweezer top, this is like top and tweezer bottom. When you say tweezer bottom, you see that both candles have almost the same size, even though it may not be exactly the same size, but it will be almost the same size. And they must have a wick to the downside. They must have a wick to the downside for tweezer bottom, and they must have a wick to the upside for tweezer top. That's why we call them tweezer, because it's more like they have a wick to the downside. Both of them have a wick to the downside for bottom, and for top, they have a wick to the upside. So a tweezer top formation is viewed as a bearish reversal pattern seen at the top of the uptrend. So for tweezer top, you always spot them at areas of support. So when the market hits areas of resistance, when the market hits a resistance and you see a tweezer form at the resistance, be rest assured that the market is likely going to drop. And when you see tweezer bottom at the support, be rest assured that the market is likely going to start going up. So that is how to trade tweezer. But the concept of tweezer is that this is the concept of tweezer. The concept is that the market gave us 2 times price rejection, because when you see a long shadow or a long wick on your chart, it means, or on the candlestick, it means rejection. It means price tried to come down, but it was rejected, right? So this is 2 times rejection. And let me give you the logic. The logic is that, okay, this is the opening price. This is the opening price at the top, right? Let's do the normal candlestick anatomy. This is the opening price. Then price came down and created a lowest point here. But it didn't close here. It got rejected. The bulls tried to push it up and they were able to push it here, and it closed as a bearish candle. Then it opened again. So, but when it opened, they tried to push it down again back to this area where the previous candle closed. And when they pushed it down, they were unable to sustain it and started going up, and it closed up. So it's telling you that a lot of buyers are already in this market and the market is about to skyrocket. That is the meaning of tweezer top. So it is 2 times price rejection. Price failing to stop at the lowest point and trying to go up 2 times in 2 different candles to come together to form a formation of a tweezer candle. So it's pretty much the same thing with tweezer top. Price is already moving up. It got up to this point, but it could not close here, and it started dropping and it closed here. Then in the following candle, the price opened here, tried to go up again, but it could not, and started dropping and dropped it dropped and closed here, which is like a very low price from the top of the previous candle and the top of that same candle, telling us that they tried to push price up here, it's rejected. Then again, try to push it up again, and it's rejected, telling us that the people that are pushing it up, which is like the bulls, are very weak and the price is about to reject. So that is pretty much the concept of tweezer top and tweezer bottom. So let's just like hide this and look at our chart and see if we are going to spot a tweezer. Unfortunately, when I was trading this market and analyzing this market yesterday, a tweezer appeared, which is like a tweezer top. You can see this is an area of resistance. I was trying to look for an entry into this market to start longing the market from this area, and the market is coming to my entry already. So I was analyzing this market yesterday and I spotted this tweezer top on the 4-hour time frame. You can see that the market is going up from this area of support. The market is going up, rejected a little bit and went up and created the tweezer top, which is telling us the bulls are trying to push the market up. It got to this stage and the price rejected and the candle closed here. Then the following candle closed here, tried to go up again and got rejected and dropped. And what happened? Price started dropping since that time yesterday. So that is how to trade tweezer top. Even though I'm going to elaborate a little bit more on it after this video, because I told you that when you see a tweezer top or any candlestick pattern formation, this is like a bearish candlestick reversal pattern, you don't enter immediately. Do you know why? Because when this pattern form, they trick you to enter, but sometimes they still try to go up a little bit or try to go down a little bit before movement. And you see that when this tweezer form, the market came down, reversed a little bit before it started dropping. So that is more like how this candlestick pattern work. Most of the time, you don't just enter them immediately you see them, and you don't trade them in isolation. You trade them at key areas on your chart where you know the price are likely going to react from. Guys, if you want to learn more about areas of value, support and resistance and where you trade from on your chart, I have a video about that where I made on my channel, and I link that in the description below so you can watch the video support and resistance, so you can understand where to trade from and how to spot support and resistance on your chart. Also, I will talk about tweezer top and tweezer bottom a little bit more when I get to the example, where I get to the section where I talk about examples and other things. The next pattern I'll be talking about is the morning star and the evening star pattern. The morning star and evening star pattern actually is one of the patterns that is a combination of different candlesticks, not just one candlestick. And it pretty much looks like the bullish engulfing and the bearish engulfing, just that in morning star and evening star, we usually have at least 3 candles forming it. It's like more like at least 3 candle formation. And if you see morning star, you see that we have 3 candles, and the evening star, we also have 3 candles. So it's pretty much like the bullish engulfing and bearish engulfing, but the difference is that we have a small candle in between them, right? And it is not necessary that one candle engulfs another, right? That is different between morning star and evening star, and also the bullish engulfing and bearish engulfing. So the logic behind the morning star and evening star is this. For the morning star is a bullish candlestick, which is telling you, which we usually look up to at areas of support or areas of demand on the chart. And for evening star is a bearish engulfing candlestick pattern, which is a bearish reversal candlestick pattern, which you usually look up to see at areas of supply or resistance. So for bullish engulfing, for morning star, what happened is that the market has been coming down and we have been seeing like a bearish candles. Then we have a bearish candle, after which we have an indecision candle. This small candle is an indecision candle. It's more like 50-50 candle. The market is not going up, it's not coming down. It's like a 50-50 candle. The price where the market opened and the place where it closed are very close to each other. The candle does not have a big body and it does not have a long hook. So it's more like a dodgy candle or an indecision candle, telling us that during this price movement, the market makers or the market movements or the market participants are undecided. They are not bullish and they are not really bearish. So that is an initial candle after a bearish candle. Then after it, you now have a strong bullish candle, telling you that these traders here that are undecided have now made a decision on where they want to go, and now they want to go bullish, because after it we have a bullish candle. This candlestick pattern is a very strong reversal candlestick pattern, and most of the time when you see them on higher time frames, they are telling you that a new trend is about to start and the trend is likely going to go very parabolic. And this candlestick pattern is actually a candlestick pattern that I saw on Bitcoin back then in 2023, January 2023, that made me take a very long, like a long position on Bitcoin. And the long position actually lasted for a very long time. So let me quickly scale to the higher time frame on Bitcoin, and let's look at the monthly time frame on Bitcoin, and let's see what happened in 2021 and 2023 rather. So this is 2023, right? This is okay, fine. This is January 2023 for Bitcoin, and you can see this movement. This is a morning star candle formation. Why did I say it's a morning star candle formation? You see that in this formation, the market has been bearish for over a long period of time, for months. This is a monthly candlestick. This is like a monthly chart. This is a bearish candle, right? Forming on Bitcoin in November 2022. Then in December, we have a candle that is undecided, like an indecision candle, telling us the markets are neither really bullish or bearish. Like, you get? And then after it, we have a very strong bullish candle telling us the bulls are now in this market for Bitcoin and the price is about to skyrocket. And what happened afterwards? From February 2023, the market has been in an uptrend up till 2024 March. So candlestick patterns like this are very strong, especially when you see them on a higher time frame. And they also work on a lower time frame. They don't only work on a higher time frame, they also work on a lower time frame, and you can pretty much use them on any time frame. So candlestick formations are very strong patterns that help you make decisions on trading. And so that is morning star for you. So an evening star is like the opposite. For an evening star, you have the market has been in an uptrend, and maybe the market hit an area of supply or resistance, and you have a bullish candlestick followed by an indecision candlestick, like a candlestick that shows you that though the market is still bullish, but at this point the market is like in an indecision stage where neither the bullish nor the bearish really have the big power. Then after this indecision candle, you now have a very strong bearish candlestick telling you that now the bears are now in control and the market is about to drop. That is what the morning star and evening star formation is all about. And like I always say about candlestick formation, you don't trade them anywhere on the chart, and you don't trade them in isolation. You trade them at key areas of value, telling us that this is an area of value that you are expecting a reversal or something to happen, and you see a candlestick formation telling you that the exact thing you are expecting is about to happen. The candlestick formation we'll be talking about is the hammer candlestick. Why do we call this candlestick a hammer? Because it pretty much looks like a hammer candlestick. If you see the formation, you see that it's a hammer candlestick. But this is the first candlestick that we're talking about that is a single candlestick formation. It's a candlestick pattern, but it's a single candle, not like the Bullish Engulfing where we have two candles, not like the Tweezer where we have two candles, and not like the morning star and evening star where we have three or more candles. And like I said, when I was talking about morning star, something I missed is that in a morning star, we can have more than three candles actually. We can have like one candle, then two indecision candle in between, or three indecision candle in between, and have like the next candle. But let's consider on the hammer now. A hammer candlestick pattern is like a reversal candlestick pattern that forms at resistance and telling you that the resistance and support, telling you that the market is about to reverse. So let's say, for example, the market is going into a resistance. I'm going to like try and spot a hammer candlestick on the chart. If you look at the market, this market at this point, you would see we have like two good examples of hammer. Let's drag this one down a little bit. So you see that we have two good examples of hammer on this chart, because looking at this market, this area is an area of supply or resistance. This area is an area of supply or resistance, right? This is an area of resistance where you are looking for opportunity to sell for the market. You sell the market if the market bounces off this area of resistance or supply. And this is also an area of demand or support. This area is an area of demand or support, right? And you can spot this candlestick pattern, this candlestick, right? This particular candlestick that I put my cursor on looks like a hammer, a little bit, but it's not exactly like a hammer. It's more like a shooting star, like an inverse hammer. But then it gives you the concept. The concept is that, all right, that is pretty much not a hammer, right? But look at this candlestick here. It's a hammer. And when we talk about hammer is different. It's very different. This one is bullish and this one is bearish. This bullish hammer, you spot them at areas of resistance, and this one is spotted at areas of support. And when you see this kind of candlestick, it's telling you one thing. This is the logic. The logic behind this is that this is the open, right? The market opened here, closed here, right? But before the market closed here, the market had already gone lower, telling us that the market got rejected. The market come along here and it got rejected to close here, telling us that at this point, the sellers tried to push the market downwards, but did not have enough power because the buyers overpowered them and come up. That is why I used to say that when you talk of candlestick, even though some candlestick might be red, they are bullish, because this candlestick is red, but it's bullish because it's telling us that the market calmed down and got rejected, and the rejection is in a very long space. So if you look at this candlestick pattern here, right here, this particular candle, you will see it's a hammer candle where markets got rejected. The market came down to this point and got rejected, and you can see it's at an area of support or area of demand. And what happened after it? The market started going bullish up to this area. So that is what a hammer means. And you can spot the one that is green at areas of resistance. If we get to the example, examples, we are likely going to spot a candlestick like this, and I will talk about it. So when we get there, so this one, if you can get it at an area of resistance, and it's telling you that even though the market is going bullish, the market is about to start reversing and start going bearish. So that is pretty much what hammer candlestick is. You can easily spot them at areas of value, and it's telling you about price rejection. Price has been rejected and is about to start going in the opposite direction. The last candlestick pattern I'll be talking about in this tutorial is the shooting star candlestick pattern. This shooting star is one of the most important candlestick patterns in the financial market, and it's one of the candlestick patterns I use a lot. And it's simple. It looks like the hammer, but it's different. If you look at them, you see that for the hammer, the rejection is downward, but for the shooting star, the rejection is upward. And this candlestick pattern is a reversal pattern in a bullish trend, telling you a bullish market or a bullish trend is about to reverse and become a bearish trend. The color of this matter most times does not matter, and the color of this candlestick pattern most times does not matter. It can be in a green color, but most times it's actually red. And what it tells us is that the market has been going upward. If you look at this, picture, you would see that the market has been going upward, right? The market has been going up, and at this point it has hit a resistance level or a area of supply on the chart. And when the market hit this area, buyers tried very much to push the price high because the market opened here, and that's why it is important to understand the anatomy of candlestick very well. This candle opened here, right? This is the opening of the candle, right? This is the opening of the candle. When the candle opened here, because the market is in the bullish movement, it started going up, right? And it went up here and created a high at this point. So this is the high of the candle. Then the market did not close at that high. The market started dropping. The price started dropping, and it closed at this point, telling us of price rejection, telling us that even though the buyers tried very much to push the price high, the sellers came in and overpowered them, and they closed very close to where the market opened, signifying a price rejection and signifies that the market is about to reverse. This shooting star candlestick pattern is very powerful, and it is actually a very important candlestick pattern in trading. So you spot them a lot and you see them a lot in your chart. So now let's get to the analysis and the example part, where we look at the chart, different charts, I will spot these candlestick patterns that we have talked about: the bullish engulfing and bearish engulfing, the tweezer top and tweezer bottom, the hammer, the shooting star, and the morning star and evening star patterns. So looking at this chart, and like I said earlier on, you only trade these candlestick patterns. You don't trade them in isolation. You trade them when you have indications that they are at areas of value like support and resistance. And you can see this particular trade that I took back in July 2023, and this one that I took also in July 2023. This trade, this pattern is like a bearish engulfing pattern because this is an area of resistance, right? This is a bullish candle followed by a bearish candle that completely engulfs it. Like a bearish candle that completely engulfs it. This is like a bearish engulfing pattern. And after the bearish engulfing pattern, what happened? The market dropped down. And, right, Euro card, this is a very good example of shooting star candlestick pattern that we just talked about. You can see the market is going bullish. Then it got to this stage where buyers try to push the market upward to these highs of this candle. But what happened after it? Sellers overpowered them and pushed the price to close here. And when the price closed here, what happened was that the market dropped up to this point. If you are taking a trade at this point and you have taken profit around here, you will have made a significant profit. That is the power of candlestick pattern. And also, this is more like a bullish engulfing somewhere around here. This is more like a bullish engulfing pattern. This is more like a hammer, right? This is more like a hammer. This is just a normal rejection pattern. This is a bearish engulfing pattern. This is a bearish engulfing pattern, and which caused the price to drop a little bit, reversed, and dropped again. So one thing about candlestick pattern is that sometimes when you have these candlestick patterns, market does not drop immediately. That's why I said earlier in this video that the candlestick patterns are just indications that the market is about to drop. It doesn't mean that market must drop at that point or will always drop, but it's an indication that the market is about to drop. Now, after the market has dropped, you now find a way to enter. You find an entry price, and I actually have a video on entries and exits on my channel. You can find the video in the description below, and you can watch that. So this is an area of demand on your chart, and you can see a candlestick that shows rejection. See, the concept of candlestick is not always about the name. It is about what message they are passing. Right here, you see that this candlestick pattern is more like a rejection candlestick pattern, telling us they try to push the price low, but buyer said no, we are going up, and they put price up here and close here, which is like a bullish candlestick pattern. Then after it, we now have a tweezer bottom. This candlestick pattern is a tweezer bottom. You can see this is the first bearish candle. This is a bearish candle that signifies the price coming down, followed by a bullish candle that also has a very long wick rejection or shadow rejection right here. And what happened after it? Market starts going up. So these candlestick patterns are very powerful, and what you can do to assist yourself is to go on your chart, mark out areas of demand and supply. If you trade demand and supply, or support and resistance, however you call it, mark out these areas on your chart and look at this candlestick. Any chart you look at, you will definitely see candlestick pattern. So this is more like, if you look at this Euro USD chart, you see that this one also looks like tweezer, rejection from the upside, and the market crashed down. And also, if you see this one is like an evening star candlestick pattern. Why did I say it's an evening star? This is a bullish candlestick pattern. This is a bullish candlestick followed by an indecision candlestick, like a dodgy candlestick, indecision candlestick, and also a bearish candlestick. And what happened after it? The market crashed lower. Again, at this point, which is also an area of demand or area of support, right? We see another candlestick pattern which also looks like a morning star. So the idea of candlestick pattern is not actually the name. The idea is the message they are trying to convey. The idea is what message this candlestick is trying to pass. Are they telling you that the market is being rejected and is about to go up, or they are telling you that the market is being rejected from the upside and they are trying to go down? Are they giving you a candlestick formation that tells you that the bulls are now trying to be in control. If you look at this area also, you will see that it's pretty much the same area that I've tested a couple of times. You will see that this one is also a morning star. This is a bearish candle followed by an indecision candle, like 50-50 candle, followed by a strong bullish candle. And what happened after it? The market went up. So all these candlestick patterns are very powerful, and they are always formed at areas of value on your chart. Note, you always have to trade them at areas of value, and you always have to like trade them. You don't always trade them in isolation. So guys, if you got value from this video, ensure you hit the subscribe button, hit the like button, and I'll see you in another one.